Something shifted this weekend, and the market hasn't reacted yet. Not because it's small, not because it doesn't matter, but because it couldn't. Right now, before Monday's open, we're sitting in a gap between what just happened and how markets will respond to it. And if you've studied markets long enough, you already know this. Gaps like this don't close slowly. They close fast, they close violently, and they catch people off guard. Let me show you the part that most people are still missing. Going into the weekend, silver wasn't in a relaxed position. It was already unstable. It had been reacting sharply to every signal coming out of the Middle East. Rising one day, falling the next. Not because fundamentals changed overnight, but because expectations kept shifting. Just recently, silver dropped sharply as uncertainty increased around Iran tensions, and rising oil prices triggered inflation fears. At the same time, analysts were already warning that precious metals could remain volatile as geopolitical developments continue to evolve. So understand this clearly. This market was already sensitive, already reactive, already unstable. And then something happened this weekend. Something that didn't allow the market to respond in real time. A key diplomatic move tied to Iran negotiations was canceled. And that matters, not because of politics, but because of what it signals. Pause here, because this is where most people make a mistake. They look at events. Markets don't care about events. Markets care about what those events change. Just days ago, there was still a possibility, not certainty, but possibility, that tensions could stabilize, that negotiations might continue, that risk could slowly decline, that probability is now weaker. And when probabilities change, markets reprice risk. But here's the problem, that repricing hasn't happened yet, because markets were closed, which means something very specific is about to happen. Instead of gradual adjustment, you may get compressed reaction. Now think about how markets actually function. During normal trading hours, information flows in continuously. Prices adjust in real time. Buyers and sellers find equilibrium. But over the weekend, that process stops. Information keeps moving, but pricing doesn't. So what builds? Pressure. And that pressure doesn't disappear. It gets released all at once on Monday. Now let's go deeper, because this is where institutional thinking becomes important. When a geopolitical shift like this happens, large funds, macro desks, and central bank-aligned institutions don't react emotionally. They react structurally. They don't ask, is this bullish or bearish? They ask, what does this do to inflation? What does this do to liquidity? What does this do to volatility? Because those three forces are what actually move markets. Let's start with inflation. When tensions increase in the Middle East, energy markets are the first to react. Oil prices tend to move. And when oil moves, inflation expectations move with it. We've already seen this pattern play out. Recent tensions and supply concerns have pushed oil higher, which in turn increased inflation worries across global markets. Now connect that to central banks. Central banks like the Federal Reserve are already in a delicate position. They are trying to control inflation without damaging economic growth. If inflation expectations rise again, rate cuts become less likely. Policy stays tighter for longer. And tighter policy means less liquidity. Now pause, because this is critical. Liquidity is not just another factor. Liquidity is the foundation of all asset pricing. When liquidity expands, assets tend to rise. When liquidity tightens, assets struggle. And right now, this weekend event may be pushing the system toward tighter conditions. This is exactly why global institutions like the International Monetary Fund often warn that geopolitical shocks can amplify inflation risk and financial instability at the same time, because they don't operate in isolation. They cascade. Now bring silver back into this, because this is where things get complicated. Silver is not just a safe haven asset. It is also an industrial metal, which means it reacts to two completely different forces. Fear. pushes silver up, economic slowdown pushes silver down, and we have evidence of this. During the recent Iran conflict cycle, silver experienced extreme volatility, dropping nearly 50% from peak to trough at one point as both demand destruction and uncertainty hit simultaneously. That tells you something important. Silver does not behave in a straight line during geopolitical stress. Sometimes it rises, sometimes it falls, sometimes it does both in the same week, because it is caught between two identities. Now layer another factor, the US dollar. During periods of global stress, capital often flows into the dollar and US treasuries. And when the dollar strengthens, it puts pressure on silver. We've already seen this recently. Precious metals declined even as tensions increased because the dollar strengthened and bond yields rose. This is the contradiction most people don't understand. Geopolitical tension does not automatically mean silver goes up. It depends on inflation expectations, central bank policy, dollar strength liquidity conditions. And right now, all of those are in conflict. That's why this setup is dangerous, because when markets face conflicting signals, they don't trend cleanly, they become unstable. Now imagine this, Sunday night. Markets begin to open, futures trading starts, liquidity is thin, spreads are wide, and the system begins to process what just happened. But here's the key. The first reaction you see is not the full reaction. It's just the beginning. Because markets process information in layers. First, hedging. Institutions adjust risk exposure. Then, volatility pricing. Options markets react. Then, narrative formation. Analysts begin interpreting what it means. And only after that does real direction emerge. If you're still watching, pay attention. This is where most traders lose money. And subscribe now. Because the next part explains what actually happens on Monday. Because right now, we are not at the end of the move. We are at the beginning of the reaction. And Monday is where that reaction becomes visible. Now let's step into the moment right now, this weekend. Because what's happening is not visible on charts yet, but it's already moving inside the system. Picture this. Sunday evening. Futures markets begin to open. The first orders hit. Liquidity is thin, spreads are wide, and something feels off. Because this isn't a normal reopen. This is a delayed reaction to a geopolitical shift. And here's what most people don't understand. Markets don't process events instantly. They process them in layers. Layer 1, hedging. The first players to react are not traders chasing profit. They're institutions managing risk, funds, banks, macro desks. They're not trying to predict the market. They're trying to protect against uncertainty. And uncertainty just increased because over the weekend, a key diplomatic effort between the US and Iran stalled, with reports confirming that talks effectively broke down after envoys' plans were canceled. Now connect that to the bigger system. This is not happening in isolation. This is happening inside an already unstable environment. There is still an ongoing conflict backdrop. There is still a naval blockade in place. There are still tensions around the Strait of Hormuz, one of the most critical energy routes in the world. And that matters, because nearly a fifth of global oil flows through that region. So when diplomatic signals weaken, markets don't just see politics. They see risk. Risk to energy, risk to supply chains, risk to inflation. Now let's move to the next layer, volatility. Volatility is not just movement, it's uncertainty about movement. And right now, uncertainty is increasing. Options markets, where institutions hedge, are often the first place this shows up. Implied volatility rises, risk premiums expand. Because when events like this happen, the range of possible outcomes increases, and when outcomes become uncertain, price becomes unstable. Now here's where things get even more interesting. Layer 3, capital flow. Where does money go during uncertainty? Historically, into US treasuries, into the US dollar, into gold. sometimes into silver, but not always evenly. This is where most retail traders get trapped. They assume tension equals silver up. But reality is more complex, because capital doesn't move based on emotion. It moves based on relative safety and liquidity. And sometimes the dollar becomes the primary safe haven. When that happens, silver can struggle. We've already seen this pattern. Even during rising tensions, precious metals have declined when the dollar strengthened and yields increased. So now we have a conflict. Safe haven demand leads to bullish for silver, dollar strength leads to bearish for silver. And when two forces collide, you don't get a clean trend, you get volatility. Now zoom out further, because this is where the real story is. The global system is already under pressure. Central banks are still navigating inflation. The Federal Reserve has not fully committed to aggressive easing. Liquidity remains uncertain. And global institutions like the IMF have repeatedly warned that geopolitical shocks can amplify financial instability, especially when multiple risks are already active. Right now, we have geopolitical tension, energy, uncertainty, inflation, pressure, policy, uncertainty. And this weekend added another layer, not gradually, but suddenly. Pay attention. This is where the real move begins forming. And if you're still here, subscribe. Because this next part is what most people never see. Now let's go deeper into silver itself. Because this is where the real contradiction exists. Silver is not just a safe haven asset. It is also deeply tied to global growth. More than half of silver demand comes from industrial use. Solar panels, electronics, defense systems. That means silver depends on growth, production, demand. Now think about what geopolitical tension does. It may slow growth, it may disrupt supply chains, it may increase costs, which creates pressure on industrial demand. So now we have two forces again. Fear, pushing silver up, economic slowdown, pulling silver down. And both are active at the same time. This is why silver behaves differently than gold. Gold is a cleaner safe haven. Silver is a hybrid. And hybrids don't move cleanly. Now imagine this moment, Sunday night turning into Monday. Orders continue flowing, but not all in one direction. Some institutions are buying, some are hedging, some are reducing exposure. This creates something important. Noise, and this is the trap. Because when retail traders see movement, they assume direction. But institutions see something else. They see imbalance. And imbalance creates opportunity. Now let me ask you something. What if the first move you see on Monday is not the real move? What if it's just positioning? Because historically, that happens more often than people think. Initial reactions to geopolitical events are often exaggerated, driven by urgency, not by full information. And then, once clarity comes, the market adjusts again. Don't ignore this. This is where most people lose money. Comment below. What's your move? Buy the open or wait? Now here's the deeper layer. And this is what separates professionals from everyone else. Institutions don't react to headlines. They react to what happens next. And right now, this situation is not resolved. There could be further escalation, new sanctions, shifts in oil markets, or even unexpected diplomatic signals. And each of those changes the entire structure. This is why Monday is not predictable, because it's not just reacting to what happened, it's reacting to what might happen next. And that is where volatility is born. Now we arrive at the moment that matters. Monday, the open. This is where everything collides, not just price, not just headlines, but an entire system trying to reprice itself in real time. Because what happened this weekend is not isolated. It's part of something bigger. Let's be clear about the situation right now. The Iran conflict has already disrupted global systems. A naval blockade has been imposed. The Strait of Hormuz, one of the most critical oil routes, has been affected, energy flows have already shown signs of instability. And now, with peace efforts breaking down again, the probability of further escalation has increased. Not guaranteed, but increased. And markets don't wait for certainty, they price probability. Now think about this. When a geopolitical shock hits during market hours, price adjusts gradually. But when it hits over a weekend, you don't get gradual, you get compression. Everything that should have happened over hours happens in minutes. That's what Monday is, a compressed reaction. And here's the part most people misunderstand. The first move is not the real move, it's the fastest move, because it's driven by urgency, by positioning gaps, by traders who couldn't react earlier. Historically, events like this often create exaggerated initial price swings, followed by either continuation or sharp reversal, depending on new information. So let's break this down properly. Silver opens higher, fast, aggressive, driven by safe haven demand, because capital reacts to uncertainty. Money moves into metals. But then something changes. Liquidity increases, information improves, and suddenly the move slows or reverses. Because the initial reaction was not based on full clarity, it was based on incomplete information. This is where it gets dangerous. Monday opens quietly. No major spike, no panic, and people relax. They assume the market absorbed the news. They assume nothing changed. But behind the scenes, institutions are still adjusting, still repositioning, still recalculating risk. And then, Tuesday, Wednesday, the real move begins. This pattern has happened repeatedly in geopolitical markets because institutions don't rush, they adjust strategically. This is the one that catches most people. Silver spikes at open. Retail traders chase the move. Momentum builds. And then a headline drops, a diplomatic signal, a policy clarification, a shift in tone. And just like that, the narrative changes. And price reverses. Hard. Because the same traders who bought the spike are now exiting. At the same time. This is why volatility increases in moments like this. Not because markets are irrational, but because information is incomplete. Now let's step back, because this is where the real insight is. This event is not finished. It's evolving. There are still variables in play, further escalation, new sanctions, changes in oil supply, diplomatic back-channel activity, and each of these can shift the market again. That's why no serious macro analyst will give you a fixed prediction here. Because this is not a fixed situation, it's a moving system, and silver is sitting right in the center of it. Now think about the bigger picture. Markets don't just react to events, they react to what those events mean for the future. And right now, the future is uncertain. That uncertainty affects everything. Inflation expectations, central bank policy, liquidity conditions, risk appetite. And when those things become unclear, markets become volatile. This is exactly what institutions like the International Monetary Fund often highlight, that when multiple risks overlap, they don't just add up, they amplify. And right now, we may be entering that phase. So don't just watch silver, watch the system, watch oil, because oil reflects geopolitical stress first. Watch the dollar, because it controls global liquidity. Watch bond yields, because they reflect risk sentiment. And most importantly, watch what happens next. Because this story is not about what already happened. It's about what happens after Monday. If you're still watching, you're already ahead of most traders. Subscribe for real macro breakdowns like this, not hype, not noise. Now let me ask you something, and think about this carefully. What if Monday is just the beginning? What if this isn't a one-day reaction, but the start of something bigger? Because historically, major geopolitical shifts don't create one move. They create cycles. Wave 1, reaction. Wave 2, repricing. Wave 3, trend. And right now, we may only be at wave 1. Comment below. What's your call? Spike or reversal? Because what happens next will not just affect Monday, it could define the next move in silver. And right now, we are at that exact moment where the market is about to decide. But here's the truth. Most people will react. Few will understand. And in markets like this, the difference is everything. Because the real move is not just about direction, it's about timing. And timing is about understanding what others don't. Right now, you have the framework. Now the only question is, what will the market do with it? And that answer is about to unfold.